Welcome in to the Retire Smart Maryland YouTube page alongside Nick Innerbichler, my business partner, my good friend. I'm Prashant Sabapathi. And Nick, let's just get right into it today. You know, we've had so many people come in and be concerned about inflation. It's such a hot topic in today's day and age. And so I wanted to kind of take a step back before we get into some of the complexities here. Can you start by just telling us what is inflation and why is it important specifically to retirees?
So inflation, simply put, is what your dollar is worth in the future.
Yeah.
Right. So right now we've heard inflation is above 8%, but that's just a basic number, right? That's not taking into account the cost of other goods or services. So I mean, everything is up right now, but it's how much more I have to spend for any particular thing that I might be buying.
So for example, I went to the grocery store a year ago. If a gallon of milk is $2, it might be $3.50 now, and that type of thing. So you mentioned 8%. I think it's really interesting. There's a rule out there called the rule of 72. Can you walk through the rule of 72 really quickly?
Sure. Yeah, the rule of 72, we typically think about it when it comes to our investments, how long it will take at a given rate of return for my money to double. So, 6% rate of return. In this case, we're talking about the cost of my money, my income, how it needs to grow in the future, right? So if I have a 6% rate of inflation and I have a $7,000 income, in 12 years, that income will have to be worth $14,000 just at a 6% rate of inflation.
That's a really interesting thing you said there, because I think one of the biggest concerns that retirees have is you're transitioning from going from a working lifestyle where you maybe have a steady paycheck coming in that you get cost of living increases on, that you might get performance-based raises on, but now you're transitioning to this more fixed income, this Social Security pension type of atmosphere. So let's just play that out. You said 12 years it would take for your for inflation to double or essentially cut in half of the value of your purchasing power. So if I'm 67 years old today and I'm retiring and I need $7,000 a month, are you saying that at a 6% rate of inflation in just 12 years, I'm actually going to need $14,000 a month for it to feel like the same $7,000?
That's correct. And that's, again, at a 6% rate of inflation.
Yeah.
Now, when we do our planning, income for life plan, we usually use, on average, about a 2.5% cost of living adjustment. That's clearly not enough in today's day and age. And we don't know when this whole period that we're in is going to end, but it's important to know, how do I get there? How do I increase my income by 6% annually?
Yeah. So let's talk about that for a second, because I know people are going to ask the question, if I have to deal with my purchasing power eroding away at 5, 6, 7, 8% per year, and I needed $7,000 a month, and 12 years from now I'm going to need $14,000. Well, how do I even deal with that, right? So this is where we get into this idea of bucket planning, right? So maybe you've saved money, you've put money away in the 401k for all these years, and you have $750,000 or $1 million. How do you put that $1 million to work for you to combat inflation? Can you talk a little bit about some of the 3 bucket strategies that we use, and maybe just give a general overview of what those buckets are and how each one of them kind of works?
Sure. It's important to have your assets be diversified. And for a lot of people, that just means having your money spread out among a bunch of different banks or different mutual funds or what have you. But the way that we look at it, the bucket planning, you have money that's used for short-term emergencies. That might be money that you have in the bank, which, of course, right now is not earning much. But then we have growth bucket. We call it the red bucket. That's money that you invest in the stock market. And again, the idea is, as we get older, we should have less money in the stock market. And that's true, but you should still always have assets that are going to keep up the best with inflation. And then the one that we like the most, and in a lot of cases people like the most, especially in a market situation we have right now, is a green bucket. It's like a personal pension. It's guaranteed. It can't lose when the market's going down. And in some cases, the income that's generated from that account can actually grow over time.
So we have 3 buckets of money. We have our safe bank money that's highly liquid, we can go access. The red bucket is going to be that money that is really used to fight off inflation in the long term, right? So the reason we call it the red bucket is red for risk, right? And so in that red bucket, we're going to ride those ups and downs like we do in the market. But the goal of the red bucket is essentially to fight off inflation over the longer term. Correct. Is that correct?
Yeah.
And then you mentioned this green bucket, which I thought was really interesting. The green bucket is, you called it protected or safe money, right? So to me, that means you put the money in, you can't lose anything.
Absolutely.
On it, right?
Yep.
But talk a little bit about that green bucket and what it's designed to do from the standpoint of income and how we look at income as one of the most important factors to a successful retirement.
So when we sit down with our clients, we say it's all about the income, right? It doesn't necessarily matter how much money you've accumulated. It's about how much income or how much your expenses are, whatever it's going to be that you can live the lifestyle you want in retirement. So the market's going to go up and down. Over the long term, it's going to do fine, but we need money that will weather the storm in the short term and provide guarantees like our Social Security, like if we have a pension. And the green bucket is very good at doing that.
Yeah.
It protects your assets from big downturns, and it provides guaranteed income as if it's a pension.
Yeah, so I go back to kind of that old saying there was on Wall Street, right? It was that when it came to your investments, you wanted to do what? You wanted to buy low and sell high, right? But the challenge is when we go through some of these down markets, like just this year alone, we've seen the market at different points in time go down 20, 25, 30%. And when you include the bond market in that, you're looking at 20 to 30%. And so if the market goes down and now we need income at the same time, we're not only losing money on our 401k, but now we're withdrawing and compounding that loss and really locking it in. So it sounds like you're saying that we can take some money from that kind of 401k plan, diversify it, put it into a red bucket and a green bucket, and maybe when the red bucket's fluctuating, we know that we need time for it to come back and kind of recover. But during that time, do we tap our green bucket or maybe our safe money to be able to generate income so that we're not selling low?
That's exactly why you have different strategies. You pull from what's doing better at the time or what's not losing at the time. So if you have all your money in the stock market and the stock market's down 20%, and you need to take 4%, 5% to create that income you need, that creates a bigger problem. You're taking more out of your retirement accounts potentially than you really need to.
It's a great point. Folks, when we talk about retirement, it's all about income. It's always about how much income you have coming in versus how much expense you have going out the door. That's while you're working, and that is while you're retired. If you're concerned about inflation, feel free to give us a call. The phone number is 443-274-3002, and we'll put together a customized lifetime income plan for you to help you understand how to combat inflation and create the income that you need in retirement. Thanks for joining us.